In today's video, we need to discuss everything going on in the market. Volatility is spiking across the board, and a lot of it has to do with Apple. Tim got cooking in the kitchen, announcing a $110 billion new share buyback program, and of course, an increase to the dividend. The stock got rallying 7% in the after hours, but does the end justify the means? Today, we're going to talk everything Apple, as well as the seasonality and hidden divergences that normally precede the all-important non-farm payroll data. We have the stats as to what happens before, during, and after the data. We're also going to be discussing sentiment, the economy, and why we need to be looking at this chart. Is it time to hedge, or is this time different? We've got a lot to talk about, so let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, like this video. We're trying to get 10,000 subscribers in May. I would really appreciate if you go ahead, subscribe, share this with anybody who may be into stocks so that we can hit that goal by the end of May. Let's get into it, guys. A very green day, a very broad-based day, but it was led by the mega caps. Look at Visa, Amazon, Apple, Google, Meta. These guys all outperformed, including Microsoft right here, as well as Tesla. Wasn't green for the day, but it was flat. And that's a stark difference to what the stock has been doing over the last year. Guys, we've seen a bit of weakness here in financials, particularly credit services. Bar PayPal and American Express, we're seeing Visa and MasterCard come under pressure after MasterCard's lackluster earnings, and I think that's having an effect on the overall bigger players here in the financial services. But we still see capital markets doing really well. You know, this entire sector reported great earnings from Schwab to Goldman, and then asset managers as well. The only real weakness we saw in an entire sector today was drug manufacturers, led by Eli Lilly, and this just tells us that it was a risk-on rally. I mean, we saw healthcare defensive sectors get sold off. We saw the defensive sector telecom services get sold off right here, and we saw less upbeat action in certain subsectors here of staples. So, you know, people were definitely favoring cyclical assets over defensive assets, and we could definitely see that. Look at the worst performing sectors for the day. XLU utilities, right? XLV healthcare, they were definitely the worst performing sectors today. I mean, sure, financials and materials were there as well, but you have to understand that financials and utilities were still positive on the day, up 0.25, 0.53%. And we look at the sectors at the top: semiconductors, regional banks, XLK technology, real estate, home construction. And it's a very clear trend. We're seeing cyclical assets, rate sensitive assets, risk on assets outperform. And we know that because look at real estate, right? And then we have home construction. Both benefited from sort of the rate cut narrative that's coming back into the market. And then we have technology, semiconductors, discretionary, software, XLC. You know, these are the mega caps. These are the big tech names. These are just cyclical assets that do really well in a risk on environment, and they all outperform the SPY. Stocks that underperform the SPY, you look at staples, right? GDX, XLI, XLE. And I think some of this had to do with what's happening with commodity prices, as well as the PMI data we got right there. But let's hop on the charts and we'll talk about everything. Let's quickly talk about the indexes, guys. So look at the S&P 500, nearly up a full percentage point. Same with the Dow Jones. The NASDAQ 100 up 1.29%. Look at the RSP up 0.62% today. So the market cap weight indices definitely outperformed. We saw that with the mega caps, to be expected. It doesn't change the fact that today was very broad based. We then actually saw, you know, we're up another 0.5% in after hours here in the RSP. The IWM, the S&P 600, they were up more than 1.5%. Bit of weakness in the after hours, but look at the SPY up 0.24%. That's on the Apple news. SPYG up 0.58% again on the Apple news. I mean, Apple rallies, the entire tech sector rallies, the NASDAQ 100 rallies, the S&P 500 rallies. It's a very big player. But the story of today was something that was really underappreciated, and it had to do with the 10-year yield. Okay, they're up a bit here in the after hours, right? But we go to the daily chart of the 10-year yield, and we actually had the second consecutive day of more than a 1% decrease in the 10-year yield, and we could possibly be forming a little bit of a top year in the 10-year yield at the 4.7 range. I do think the market got a bit ahead of itself with rate expectations, both here in January, February, you know, pricing in 7 cuts, and then up here pricing in only 1. Some people pricing in potentially even a hike. And we look at TLT, right? We zoom out on a year-to-date basis. Okay, it's down nearly 10% year to date, but we keep zooming out right here. This was the October lows, and we're very close to this 82, 83 area right here. And I do think that, you know, if you want to get into longer term bonds at this rate right here, it should provide a bit of a tailwind because we are sort of finding a bottom. And you should have a bit of a rally up here to the 93, 94, 95 area. I do think rates are going to pull back a little bit, but on a long-term basis, I wouldn't really hold bonds in your portfolio in terms of as a position for capital appreciation. For yield, for sure, 100%, but not really for any long-term capital appreciation as an investment. That's just the way I see it right now. I think in this market right now, you kind of want to hold more stocks and commodities than you do want to hold stocks and bonds. If inflation does get sort of below that 2% mark, then you can start looking at bonds over commodities. But right now I do favor commodities as a whole. Looking at Bitcoin up 1.54%. Is that after hours? No, that's actually the day's trade today. Gold was down 0.72%. Silver was pretty much flat on the day, but look at the volatility there we're seeing in the chart. The dollar did lose ever so slightly. Not a bad thing. This is part of the reason why the mega caps did rally. The dollar is coming down along with rates. And then oil, continues to be in the $78 to $88 range, but it does look like crude is breaking down here and probably looks like we're going to this 77 range in this area right here. We'll see what happens over the next couple of weeks. Now let's look at the S&P 500 and let's start on the weekly chart, guys. So we do know this for a fact. At the end of the day, we are in a uptrend on the weekly, right? You can see that we're putting a low, higher low, higher low, and we're trying to put in a higher low right here in this situation, and it looks like we have. At the same time as we put in our higher lows, we actually put it at an all-time high, bullish, and we've made higher highs along the way. Now, you can actually say we did put in a higher low right here, and that we are putting in another higher low at this point right here. But I really like to look at this as the ultimate low for this low right here, because these are, I would say this is more of the breakout from this low more than anything else. We are putting in a higher low right here, and we are trying to find strength to move on the way up. So the weekly chart is looking bullish. However, on the daily chart, we are breaking down a little bit. We are in a daily downtrend. We're making lower highs and we're making lower lows relative to the lows put in recently. We have tried to rally. We put in a high. However, relative to this high right here, it is a lower high. We have then pulled back. Now, we are putting in higher lows in terms of this low, higher low, and then we're trying to find a bottom right here. But what this market really needs to do is go ahead, rally, and break this 5120 area. And based on the earnings we're seeing with Apple, based on what we're seeing in the after hours, that could happen tomorrow, but it's going to require a lot of rally because bears are really emboldened at this 5120 level. As it stands right now, bulls are looking at this 5000 as a very, very strong support zone. Bears are looking at 5100, 5120 as a great short zone. And until we actually break above or below this area, that's going to dictate the next move. Until here, we're in no man's land in this area right here. So it's really just who's going to win, the bulls or the bears. But based on this price action, it does look like the bulls are taking a stand because we are putting in higher highs. And we actually did put in a high right here. We do pull back. As long as the high is met by a higher low, we can actually continue the rally upward. And I do see that happening, especially with Apple's earnings. What is Apple doing right now? Let's have a look. Look at the post. It's sitting at 184. This is like a 6.5% move here in the post. That's really going to support the market as a whole. What's the QQQs doing? Qs is up 0.5% in after hours after being up 1.28% here. A lot of strength exhibiting here in technology, the leaders of the pack. And then we also have a look at stuff like Nvidia up 3% for the day, up 0.62% there. But all in all, guys, you have the levels. If you're a bull, you want to buy here at 5,000. You want to hold the 5,000 line. If you're a bear, you want to hold the 5,100. And if you're a bear, you critically want to hold that 5,100 area because 5,100 is the gamma flip. The second we get above there, we start having dealer supportive flows, and then it's buy dip, sell rips, new all-time high. So if you're a bear, you want to hold that 5,100 area with your life. Your life depends on it. Your shorts depend on it. Your margin call depends on it. Now, guys, we're wrapping up a pretty big week of earnings right here. There's been a lot of drama, but today we are going to take a look at one of the biggest players in the game, Apple. Guys, let's talk about Apple. They beat EPS, they beat sales. I know there's an X right there, but they did beat sales just. They actually raised their dividend by 25 cents. That's a 4% year-over-year increase. And then the board authorized another $110 billion in a share buyback program. Now, it says here the stock was up 3.5% after hours. They're actually up like 7% now when I last checked. So very good earnings, not quite the dumpster fire we were expecting, but this is still, by the way, like a negative 3% year-over-year revenue growth. So, Apple's still contracting on the revenue side. And this is the 5th out of the 6th quarter of of year-over-year revenue decline. Definitely the buybacks are really helping the earnings per share front, but this company is really big, it's really saturated, struggling to grow, especially with China coming under pressure. But it does look like this is an inflection point here for Apple, and we should really see revenue growth over the next coming quarters, which should really support asset prices. And I think the markets really like that. They're saying, look, kind of the worst for the revenue side is behind Apple. We're seeing China have a recovery. We saw, look at the K-Web doing really, really well. We saw Baba up like 6 or 7%, PDD, JD, all those stocks were really up in trade today. If those stocks are bottoming, that probably means the worst of the China economy is currently here right now, and we're looking towards better days in the near future, and that's going to really benefit Apple. So that's why the stock is up very big in the after hours, as well as all of the money they're returning back to shareholders. And there was also a lot to love about this earnings report. Tim Cook said he's going to be teasing a new product next week. I think margins came in line. They guided for single-digit revenue growth, so a lot to like with this report. Maybe Apple has actually found a bottom here in terms of the actual revenue, which is really, really good, returning cash to shareholders, and that's why the stock's doing so well in the after hours. Now, quickly looking at our earnings scorecard, earnings continue to accelerate to the upside. So despite the drama you're seeing in these high impact names, the names with a lot of news appeal, like Starbucks, like FedEx, if we actually dive under the hood, you don't want to be swayed by the fear, uncertainty, and doubt. S&P 500 earnings are coming in really good in aggregate at 6.6%. Start of earnings season, the expectation was 3.5%. Excluding this weird BMI adjustment, we're looking at a 9.7% earnings growth for the S&P 500, and that excludes energy as a whole. And on the revenue front, we're actually coming in a little bit better than expected. You can see that S&P 500 companies are growing top line, growing bottom line, and excluding some one-off charges, things are looking really good. This is exactly what you want to see. And any dip we do get in the S&P 500, that is just an opportunity for you to go long, because the fundamental picture is looking really, really good right now. Now let's talk a bit about sentiment, guys. So this is the AA sentiment survey, something we look at very religiously, something I like looking at. We've seen a recent downtrend here in bullish sentiment, but we have seen a pretty big uptick this week from 32.1% to 38.5%. But at the same time, we've actually seen the bears hold the line, and that pretty much tells me that a lot of people here in this neutral position have just taken a bit of a bullish stance. And while a lot of bears are still the same from the same week, so the same people who were bearish are bearish, but those who are neutral are a little bit more bullish, and that does help the bull case. But we'll see how this unfolds. It has been a very turbulent week with earnings, with data, but the risk is still skewed to the upside and the sentiment is still bullish. Now, with this bullish sentiment, should we remain bullish into the rest of the year, and what do the stats tell us? And this data right here is the returns of the S&P 500 after we have our first negative month after successfully completing a turn of the year hat trick. Now, the turn of the year hat trick is when we have a positive December, January, and February. We did have a negative April. We were down about 4.6% after a vicious last day of trading took us down nearly 1% in the S&P 500. But the forward returns after the first negative month tend to be quite positive. You can actually see right here, 1 month later, 21 wins, 4 losses, very positive, 2.54% return. 3 months later, 4.1% return, 20 wins, 5 losses, and then 8.58% return. 6 months later, 22 wins, 3 losses, and then we actually have the max drawdown right here. Now, the max drawdown can be quite substantial, so we do actually get very positive returns, but what you have to understand is that, for example, this right here, max drawdown, 15.57%, that means that the markets actually did fall 15%, and that would represent a buying opportunity. So you can see here that apart from 2 isolated years in 2011, 1998, the max drawdown tends to be fairly minimal. In 71, we also had a 9.5% drawdown, but there's a lot of years when it was 0 and a lot of standard drawdown periods. And I would call a standard drawdown anywhere from 3 to 5%, like we had here in 1950, 1951. And that just means in these drawdowns, during this 1 to 6 month period, you want to buy the dip and you want to hold the line because higher prices do normally ensue. The stats are skewed to the upside, to the bulls. Now, let's talk a bit about the economy. We got the latest GDP Now data, and we can see that Fed GDP Now was tracking at 3.9%. That has actually fallen just about 3.1, 3.2% here in the Fed GDP Now, well above the blue chip consensus, which is sitting at about 2% GDP for the second quarter. Now, I covered this in last week's video. Q2 GDP should be much stronger than Q1, making up for the weaker quarter that we just had, because cyclical components of GDP will remain strong because of fiscal, but net exports and inventory should add tangibly to the Q2 print. Now we got PMI data yesterday. I didn't cover it in yesterday's video, but we actually had a miss in PMIs. And I think this did help a little bit of sentiment. It did help the inflation story because we tracked in at 49.2. We were expecting 50. In fact, the trading economics forecast was 49.9. And this is a contraction. So PMIs did miss yesterday, but you have to look at the trend and we are moving upward, and PMIs are finally coming out of this recession we're being in, and we're starting to see a real recovery in the manufacturing front. And generally speaking, the sectors that you want to be in during a PMI expansion cycle is actually financials, consumer discretionary, materials, and comm services. These four sectors provide the most outsized returns. But when it comes to the S&P 500, when we enter these PMI expansion cycles, we can see again outsized returns anywhere from 12, 24, 36 months later of returns and gains upward of 20 to as high as nearly 40% here in the S&P 500. So as we exit this PMI recession, we do want to look at the stats and be invested in the right industries because we can make a lot of money out of this, and this is a reason to be bullish. PMI expansion cycles are normally very bullish for equities. Now that's manufacturing. Let's talk employment. We got the ADP employment data and it was looking rather strong. Change in US private employment here in April was 192,000, and you can see that gains in employment were actually fairly broad-based. Apart from 20 to 49, we saw down 1,000 employees. We saw gains in almost every industry. Now it's not all sunshine and roses. We actually got the JOLTS data at the same time, and what we can actually see here is that jobs opens continue to decrease, but the actual job openings came in at 8.48 million. The consensus was 8.69 million, so we did miss. Job openings did miss by quite a bit. This is the JOLTS data, and we are continuing to see this disinflationary trend. However, when we look at the bigger picture, job openings continue to remain robust, and they are still well above the pre-pandemic average. And this disinflation that we're seeing right here is nothing more than reverting back to trend, reverting back to the mean. So now what about non-farms? Because that's the big print we want to look to. Now BOFA here is expecting 250k forecast in April. Now just for the record, we were expecting 213k for this print right here. It came in at 303. It was a huge beat, and we've actually seen employment accelerate here for most of 2024. Employment has actually been accelerating, and that's really kept inflation a little bit sticky, particularly wage inflation and employee compensation. But on Friday, for the non-farms, we are expecting 250,000 payroll increase. Now, how do we play this with the S&P 500? I have the data right here, and this is essentially the 5-day, 1-day returns before the non-farms. This is the non-farm print, and then 1-day, 5-day, 1 month after. Now we can see here on the March print, we had 303. We were expecting 213k. That did come in a bit hot. Now we did actually gain 1.1% on the day after. However, the 5 days after, we did actually fall 1.6%. You can actually see we had a hot number here at the February print as well. We were expecting 200. We got 275, and the 1-day reaction was actually fairly negative. The 5-day reaction was -2, and the 1-month reaction was also very negative, especially for a 1-month return. Now looking at the averages, we normally actually do have a negative S&P 500 1 day into the print, but we normally do print a positive 1 day after, 5 days after, and normally 1 month after. Now this is since September 2022 when we have been in this bull market, so do take this data with a grain of salt. It's not a full amount of data that we can really rely upon. That being said, we can still look at something like this and say, hey, these are the data points, and normally non-farms 1 day before offers a good dip buying opportunity for us to go long to get outsized returns up to 5 days, 1 month later. Let's talk gamma, guys. Very interesting. Not much has changed from yesterday. The 5,000 level continues to be the put support, 5200 the core gamma resistance, and this 5100 right here is the gamma flip zone. So right between 5,000, 5,200 and 5100 is where the S&P 500 is going to make its stand, and we're clearly seeing that in the price action today. We really saw a big rally up to the 5100 area here in the S&P 500, and look, if we clear that turn resistance into support, we're probably going to buy dip sell rips all the way to 5200. We are incredibly bullish above this 5100 mark, and look how good these levels are, guys. We found support right at the put support. It was at 4,900. We then wicked below. The put support moved up to 5,000. We then used the 5,000, the put support, as a very strong support zone, and we're now rallying back to the gamma flip zone. up to the 5200 area is the very likely scenario, and the 5300 strike is building out. What does this mean? Guys, if we're above 5100, you will really want to just buy dips, sell rips. You want to have exposure to equities because we are going to go higher. And I think, you know, between now and March and May OPEX, which is the 15th, I think that's a very bullish period, especially with the amount of negative gamma that's in the tape and the fact that we continue to rally. That is insanely bullish, and do expect a lot of this negative gamma to start to roll off the tape into the May OPEX. Now, looking at S&P 500 seasonality, guys, so this is for the month of May from 1950 to 2023, the average performance in May. Now, you can normally see we tend to have quite an upbeat start to May. We sort of form a double bottom, but a lower high double bottom right here, and then we actually go on a fairly bearish run throughout May, and this is where the sell in May trope comes from. Then around the 25th, sort of around this last week of May, we bottom. This probably coincides with OPEX. It normally always does, and then we do see quite a rally which takes us from a negative return here in May into the positives, and we finish up about 0.25% here in May. However, this can cause a lot of grief, and don't want to be shaking out your positions if that does happen, guys. Do understand that we can get quite a bit of selling pressure in May. It's just seasonality. Now, looking at overall breadth, this is actually a fantastic chart. This is percentage of stocks above their moving average, the S&P 500, 400, 600, and the NASDAQ 100. And you can actually see that the shorter term breadth metrics, the 5-day moving average, 20-day moving average, as well as 50-day moving average, are looking rather messy. They're coming under a bit of pressure, but these longer term metrics, look at the 150 moving day, look at the 200 moving day. This is very, very healthy right here. So on a longer term basis, things are looking really, really healthy. It's just on the short term, it's not looking too good. Guys, data tomorrow is the big one. That's all you want to focus on, non-farms. We covered it in this video, but what you also want to look at is the unemployment rate right here. We're expecting 3.8%. That's the consensus. And then average hourly earnings month over month, 0.3%. Just be wary. BOFA is expecting 0.4%. And then average weekly hours of 34.4. So just a couple of things to be aware. We have non-farms tomorrow. It can get very volatile. It's the thing that causes some of the most insane volatility, particularly with currencies, dollar, with rates, and that can really affect the inflation narrative. So go in tomorrow expecting a lot of volatility. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers.